One Financial Markets is an authorized financial service provider both in the UK as well as here in South Africa. My name is Brandon Flynn. I'm a trading educator, technical analyst, and trading coach. Been teaching and training clients to trade on the world's financial markets for the past 8 years now. Thank you for watching our beginners training videos. This is the third video in our training series, basic trading concepts, terminology, and principles. And in this video, I'll be going through three main sections. Firstly, I'll go through the trading concepts where we'll cover the basics of the different markets. I'll go through the main economies and show you the market trading times, opening and closing, and the overlaps in the markets. And we'll discuss margins and leverage in some more detail. And then in the second section, I'll go through trading terminology and get you acquainted with what pips are, decimals, what it means to trade a lot, and the primary and quote currency aspects of a currency pair whilst trading. And then thirdly, we'll go through trading principles, and I'll show you the different types of order types, such as the buy limit, sell limit, etc. And then I'll show you how to modify your orders, and I'll also share with you some tips and tricks pertaining to the trading platform, and I'll show you some trading styles, and from the trading styles you'll be able to ascertain which type of trading style might suit you best based on your risk appetite, time constraints, and capital constraints. Let's talk about the basics of trading on the world's financial markets. The global financial market, or the world's financial market, is made up of the main players or the main economies of the world, such as the American economy, the European economy, the Japanese economy, Australian economy, etc. And financial products can get traded in two main ways. You have the financial products or the financial instruments that are exchange based, traded on the stock exchanges, such as the New York Stock Exchange, the Johannesburg Stock Exchange. And then you also have what we call over the counter financial instruments, or over the counter trading. Those are OTC products, and they are either traded amongst a network, such as Forex, for example, which is traded via means of a network of the banks and market makers. And then you also have the direct market participants, which make up the market as well, not only the institutions but the individuals. And CFDs, or contracts for difference, which are derivative financial product, are traded over the counter, and are brokered either by brokers or financial institutions in each of these financial economies. And irrespective of where these financial products are traded, whether they be exchange-based products or whether they be OTC-based products, and irrespective of what type of financial products are traded, whether they be Forex or CFDs, all of these financial products are affected by the economic as well as political factors of each country, which in turn has an effect on the supply and demand. And as you may know, Economics 101, that which affects the supply and demand affects in turn the price. As you have more supply in the market, prices usually fall, and as you have more demand, prices usually increase. And therefore, trading can be quite simply the art of defining areas of supply in the market where we look to see prices decrease, or alternatively, where we identify areas of demand in the market where we look to see prices increase. If you are taking notes, you might want to pause this section and write down these main economies and the opening times of these markets. When these various stock exchanges are open for each of these economies, you will find the most trading activity for that specific country. That's not to say that trading does not occur after hours. It just won't be traded with as much liquidity, and some of the products that are traded during the exchange hours obviously will not be traded during after hours trading times. Some products, such as Forex for instance, are traded 24 hours a day, 5 days of the week. CFDs, likewise, being an OTC product, are also traded 24 hours a day, 5 days of the week. However, when the main stock exchanges of the world are open, you will find that these financial products are traded with much more liquidity, and also the markets move a lot quicker and a lot faster. You'll find much larger rallies in the market during the main opening hours of the main stock exchanges throughout the world. Often I'm asked when is the best time to trade. Well, as I said, the markets are basically open 24 hours a day, 5 days of the week. There will be a market available to trade. So it very much depends on what type of products you are looking to trade, what type of financial instruments, and then what your strategies are and what your holding period is for each of those financial products that you are looking to trade. However, in terms of liquidity and market activity, the most liquid times to trade, or the times when you'll find the most movement in the markets, are when there are overlaps in the market. Uh, when I say overlaps, I mean the one market might be open at the same time as another market. So, for instance, this slide over here gives you an idea. The the Australian market in Sydney is opened up. It opens up at 12 o'clock South African time, and it's often at the opening and closing of the main financial economies that we'll see some of the major rallies in the markets. So as you can see over here, there will be an overlap with the Tokyo session when that market opens up at 1 o'clock, an hour into the Sydney session. So during this period over here, 12 o'clock through to about 3 o'clock South African time at night, there will be quite a lot of activity in the Asian market. However, the Asian market moves quite a bit slower compared to the European and American markets. Much larger volume gets traded on the London Stock Exchange, New York Stock Exchange. So when the European markets are open and the American markets are open, it's during these periods that you'll find some of the most market activity, the most liquidity in the market, and often you'll find some of the longest rallies in the markets during the London session, and then also during the New York session. So when the London market, the London Stock Exchange, it opens up normally at about 9 o'clock, give or take, daylight savings time here in South Africa, or 10 o'clock respectively here in South Africa. It's during this period in the morning that you'll find some substantial market activity, and also it does overlap with the Tokyo session. So during the South African morning, from around 9 o'clock through to 11 o'clock, we often find the markets trade quite turbulently when the European session is open concurrently with the Tokyo markets. So it's during this time that we find a lot of liquidity in the market, and often the markets will rally quite substantially during the morning session. Then the markets can sometimes quieten down about midday South African time, from about 12 o'clock through to 2 o'clock. Of course, when all this is dependent on economic announcements as well. If there are major economic announcements at 10 o'clock, 12 o'clock, 3 o'clock, etc., these can also move the markets quite substantially as well. Then after the quieter 12 o'clock through to 2 o'clock session, South African time, then when the New York Stock Exchange opens up, the American markets open up, that also can be quite a turbulent session when there's increased liquidity in the market. So from the South African afternoon around 3 o'clock through to say 5 o'clock, it can also be quite a turbulent session when there is a lot of activity in the market, and the market can rally quite substantially as well. However, even though these are the main market economies and opening times to be aware of, and the overlaps in the markets that one can consider in terms of liquidity and market activity, and when one might see some of the more substantial rallies in the markets, this is not to say that you cannot trade during the thinner trading sessions when there aren't overlaps in the market. And also do bear in mind that OTC products can be traded irrespective of whether the market, when I say the market, the stock exchange for that particular country is open. So for instance, you can trade Forex, you can trade CFDs, even if the London Stock Exchange, the American Stock Exchange, is not open. or even for that matter, the Johannesburg Stock Exchange. So you can trade 24 hours a day, 5 days of the week, and what you would look to consider is your trading strategy and how long you're looking to hold those financial instruments for. Are you looking to hold them for just a few days, a few hours, or are you looking to hold them for a few weeks? I would take those factors into consideration together with the market opening times and the overlaps when you are looking to open up positions on the market. Now that we've discussed when you can trade on the world's financial markets, what I'm going to be doing is I'll go into some more detail as to what is available to you to trade on the world's financial markets. And I'll start by going through some of the most popular financial instruments that are available to trade. So let's start firstly with Forex, or currency trading, or spot FX as it is also known. And essentially what you are doing when you are trading currency is you are exchanging one country's currency for another in the form of a pair that's traded. So for instance, you have the USD ZAR, and what you're trading when you're trading the USD ZAR, you're trading American dollars paid up against the South African rand. So you might anticipate that the rand might weaken against the American dollar. For instance, the rand might be trading at, let's say, 10 rand, and you might anticipate that the rand might go up to 18 rand to the American dollar. So in which case you will take South African rand, you'll buy dollars in anticipation to sell those dollars at a later stage when the rand has weakened to the higher price of, let's say, 18 rand to the American dollar. So if you're looking to trade Forex and add certain currency pairs to your watch list, you might consider the following currency pairs. These are what we call the major currency pairs, or the major FX pairs. And as you can see, they're comprised of the world's major economies. For instance, the European, American dollar, British pound, Japanese yen, Swiss franc, etc. Where the euro, USD, is probably the most commonly traded financial instrument across the world with the highest liquidity. So most certainly, if you are looking to add any financial instrument to your watch list, you might look to consider the Euro USD. In fact, some people only trade one financial instrument. They don't even trade any other financial instrument. They only specifically look at one financial instrument. If you were looking to trade one financial instrument, you might look to trade the Euro USD, as most trading is done in the Euro USD. It is the most liquid currency pair of all currency pairs, and most trading gets done in the Euro USD. Then we also have the GBP USD, that's the British pound paired up against the American dollar, as well as another very popular currency pair to trade is the USD JPY, that's the Japanese yen paired up against the American dollar, and then also the Swiss franc, the USD CHF. And ideally, as a foreign currency trader, you'd be looking to buy at the lower price in order to sell back at the higher price, or alternatively, if you're going short in the market, then you would be looking to sell at the higher price and buy back at the lower price. And to use the example of the USD ZAR, if you anticipated that the rand might weaken against the American dollar, then you might buy at, let's say, 10 rand in order to sell when the rand might weaken, let's say, to 15 rand to 1 American dollar, thereby profiting by 5 rand. And on the alternative, if you anticipated that the rand might strengthen against the American dollar, then you might sell the American dollar at, let's say, 15 rand in order to buy back at 10 rand to the American dollar, thereby profiting by 5 rand. As a forex trader, you can go long or short depending on whether you anticipate the quote currency to weaken or strengthen against the primary currency that you might be trading against. And then another very popular financial instrument to trade is, of course, gold. And gold can be traded in the form of spot gold. XAU USD is the symbol for trading spot gold. Do bear in mind when you are trading gold that one lot will equal 100 ounces, 100 troy ounces of gold. And as gold is seen as a safe haven investment instrument, often investors and traders will look to trade gold in times of volatility in the markets. So there you go. We've discussed 6 financial instruments that you might look to add to your watch list in your MetaTrader 4 trading platform. Or alternatively, if you are taking notes, the USD, ZAR, Euro USD, GBP USD, USD JPY, USD CHF, and XAU USD are the symbols you might want to jot down as popular financial instruments to look to trade. So now that we've spoken about some of the very popular spot financial instruments that you might look to trade, spot currencies or spot gold, let's talk about some CFDs. Remember, CFDs stand for contracts for difference, and much like the spot products that we spoke about, the CFDs are also an OTC product, over the counter traded, and with a CFD you will not be taking physical delivery of the actual financial product, but rather you're actually trading the value of the underlying financial instrument that the CFD is attached to or derives its value from. And then some interesting facts pertaining to each of the specific asset classes that you might be looking to trade. If you'd like to pause this video and maybe jot down those notes, if you would like some further explanation pertaining to each of these asset classes and how they are affected by the financial climate overall. Well, now that we've discussed when you can trade on the world's financial markets and what is available to trade on the world's financial markets, let's go into more detail as to how you can start trading on the financial markets. I'm going to talk to you in detail about margin and leverage. You might remember in the introduction to trading presentation, which you might have attended, we spoke briefly about margin and leverage as per this property example. And with derivative instruments such as CFDs and spot forex, spot gold, etc., you can trade a much larger asset, or you can command an asset on the market to a much larger value than your initial deposit or margin requirement amount, as you can similarly with property if you are financing it through the bank. So let's touch on this example very briefly. As you may know, you can get a property financed by the bank. Let's say you bought a property for 1 million rand. That would be your asset value where you purchased the property. However, let's say you financed that deal with the bank, with a bond, and the bank said you needed to put down 10%, or in other words 100,000 of that asset value. So you could in fact be commanding that asset on the market with only a small deposit down, 10%. And as you know, 10% goes into 100 times. Therefore, you are gearing your capital or your deposit of 100,000 by 10 times. Or another way of saying it, because you have exposure of your deposit to your asset value of an amount of 10 times, you are in fact applying leverage to the amount of 10 times your deposit amount. As your deposit amount of 100,000, which is 10% of the asset's value, exposes you to an asset that is 10 times greater than your deposit amount. And that's quite simply what we mean by leverage. How many times greater than your deposit is your asset value, which you can work out by the simple calculation of taking 100%, your total asset value, and dividing it by your deposit percentage. So in other words, 100 divided by 10% is equal to 10, and therefore your leverage would be 10 times. And then in terms of profit, as you may know, your profit is calculated on your assets value. So let's say, for instance, you sell your property for 1.2 million, you will then make a gross profit of 200,000, which is yours to keep. And similarly with these derivative products such as CFDs and spot forex, spot gold, etc., which we've been discussing, you can command assets to a much greater value than your initial margin or deposit amount, and when you make a profit on your asset value, that amount gets immediately accrued to your trading account once you close your position. Now, as we've discussed margins and associated leverage, just bear in mind that leverage quite simply allows you to control a relatively larger asset with only a fraction of the total amount down. So to give you a quick example, let's say you were to buy one lot of the Euro USD, or in other words, $100,000 worth of a position. Now, with a margin requirement of 0.25% of $100,000 as your deposit amount or your margin requirement to open up that position, your gearing or your leverage would be 400 times, because 0.25% goes into 100 400 times. So if you take 100 divided by 0.25%, you're going to get 400. And so we know that our leverage is 400 times, or in other words, your margin amount is going to expose you to an asset that is 400 times greater than your margin amount if your deposit requirement was 0.25% of the total asset value. Or of the, let's talk specifically of this example of 100,000. If your margin deposit requirement is 0.25%, that will be $250. So now, let's say for instance you knew that you had a margin amount of $250. You times that by your leverage of 400, and therefore you would be able to open up a position of 100,000 on the market using a 400 times leverage with only $250 down. So as you can see, through the use of leverage, you can basically take advantage of very small pip movements in the market, in fact decimal movements in the market, by trading a much larger volume with only a small initial deposit amount down, or what we call margin. Let's go through this table very quickly. Let's say for instance you wanted to trade an instrument such as one of the forex majors, which we've now given you an example of, where you traded $100,000 as your asset value, or in other words one lot, and your margin requirement amount were 0.25%. That would mean that your margin amount would be $250 if you were trading, let's say for instance, the Euro USD with your asset value being 100,000. So of 100,000, 0.25% is $250, and 0.25% goes into 400 times, and therefore your gearing or your leverage is 400 times. So quite simply, as we said, when we're talking about gearing or leverage, what we mean is how many times is your margin amount or your margin requirement going to expose you to an asset. And as we said, 100% or your total asset value divided by 0.25%, your margin requirement in this instance would be equal to 400 times. So we know then that with an amount of $250, times that by 400, you would then be able to open up a position on the market to the value of $100,000. And for the other financial instruments, let's use spot gold as another example. Let's say for instance you wanted to open up a position to the value of 100,000, and your margin percentage requirement were 0.5% of the total asset value. That would mean that since 0.5% goes into 100% 200 times, that your gearing or your leverage would be 200 times. And so in other words, your margin amount would expose you to an asset that is 200 times greater than what you're putting down as a deposit. And let's say on other financial instruments such as indices, where your margin percentage requirements might be 0.2% through to 1% of the total asset value, that would mean that your gearing would be 100 times or greater. If you'd like to check the specific margin percentage requirements for the various financial instruments, you can visit the main website, onefinancialmarkets.com, and then click on Markets, and this will give you a breakdown of the various margin percentage requirements for the specific financial instruments that you might be looking to trade. So let's say for instance if you wanted to trade one of the forex currency pairs, and let's say it were the Euro USD, then you can find over here your margin percentage requirement, which in this case would be 0.25%, of the total asset value. On bullion, indices, treasuries, etc., you can just click on the applicable asset class, and then you will be able to find what the margin percentage requirement for that specific financial product is that you might be looking to trade. So now that you are getting acquainted with margins and leverage, let's progress further and talk about some trading terminology. Let's talk specifically about what we call the primary and the quotation currency in a foreign currency pair. And this will give you a good understanding of how foreign currency prices are actually quoted. So let's say, for instance, you saw this symbol over here, USD ZAR. That's the symbol for the American dollar paired up against the South African rand. And further to the right over here, this is what we call the quote price, 13.2057. So we know then that it would take 13.2057 Rand in order to buy one American dollar. So the first currency that you see here in the currency pair is what we call the primary or the base currency. And the second currency that you see here in the currency pair is what we call the quote currency. So quite simply, when you are looking at a currency pair, always bear in mind that the first currency in the currency pair is the primary currency pair, and the second currency in the currency pair is what we call the quote currency pair. So the price further to the right is what it would take in the quote currency to purchase the primary or the base currency. So let me bring up some examples from the MetaTrader 4 trading platform. What I'll do is I'll drag in the market watch window on a tick chart. Then you can have a look at the quote currency for each of the specific symbols that I bring up. So in this example, we've got the USD ZAR, which we've been discussing. And as we mentioned, the second currency in this currency pair is the quote currency, in this case being the rand. So the quote currency being represented over here, 14.21690. So what that means is it takes 14.21690 rands to buy one American dollar. Let's go to another example, the Euro USD. Let's put it on a tick chart. Now, the currency pair that we're looking at is the Euro USD. That's the European currency paired up against the American dollar. Now, the second currency in this currency pair is the American dollar, and therefore the quote currency. So, as we see the price fluctuate over here, this quote price, we know that that is what it costs in American dollars to buy 1 euro. In this instance, $1.0616 will buy 1 euro. Let's just go to another one. AUD USD, that's the Aussie dollar paired up against the American dollar. Second currency in this currency pair being the American dollar, and in this instance it will take 0.7260 American dollars to buy 1 Aussie dollar. Let's go to one last example. Let's use a cross currency pair as an example. AUD JPY, that's the Aussie dollar paired up against the Japanese yen. Second currency in this currency pair being the Japanese yen, and therefore this quote price over here means that 88.558 yen will buy 1 Aussie dollar. So now that you understand what is the quote and primary currency in a currency pair, let's talk about some other terminology as it relates to trading on the markets. Let me introduce you to some further trading terminology. Let's talk about pips and decimals. Now, quite simply, when we're talking about pips, we're talking about the smallest increment in which a foreign currency pair can be traded in. Pips stand for percentage in points. Now, on most forex pairs, the pip increment is quoted down to the fourth decimal. So to give you an example, 1 pip would be equal to 0.0001, the fourth decimal. or 15 pips would be equal to 0.0015. Now, I say most foreign currency pairs. There is an exception where foreign currency pairs are not quoted down to the fourth decimal, and that is in the instance of the Japanese yen currency pairs, where a pip is quoted down to the last two decimals in the quote currency pair. So to give you an example, in a Japanese yen currency pair, 1 pip will be equal to 0.01, or 15 pips would be equal to 0.15. And with recent developments in technology, we're now able to get quotes down to the fifth decimal, but pip increments still remain at the fourth and second decimal places. So just to give an example, 1 pip or 1.5 pips will be equal to 0.00015, and as you can see, the fifth decimal is smaller than the other four previous decimals. And that's in most currency pairs. You'll find quotations down to the fourth decimal, with the fifth being an incremental decimal, or in other words, a point of a pip. 1.5 pips in a yen currency pair would be quoted as follows: 0.015. And once again, as you can see, the third decimal, or the last decimal in this in the quotation, is much smaller than the previous two decimals. So we know it's an increment of a pip, or a fraction of a pip. What I'll do is I'll pull up a dealing ticket from the MetaTrader 4 trading platform, just to familiarize you with how currency pairs are quoted. So let's go firstly to our local currency, the USD ZAR. As you can see over here, it's quoted down to the fourth increment, or the fourth decimal, with this fifth decimal, the last decimal over here, being smaller than the previous four decimals. And that means that this is a fraction of a pip. Let's go to the Euro USD, also quoted down to four decimals, with this last fifth decimal being a fraction of a pip. And then remember that most currency pairs are quoted down to the four decimals. However, there is that exception of yen currency pairs. So what I'll do is I'll go to, let's say for instance, the USD JPY. That's the American dollar paired up against the Japanese yen, and as you can see, there are two decimals after the point in the yen currency pair, with the third decimal being smaller and a fraction of a pip. So we would read this price over here as being 54.5 pips. And this allows us to get better pricing accuracy when we are trading, because of the fraction of a pip that we are now able to trade in. So say for instance, if we wanted to be more specific about our order, and we wanted to place an order at 54.2 pips or 53.8 pips, as you can see, we can be more specific as to our order requirements if we are trading down to a third decimal. Some more trading terminology for you to be aware of. When you are looking to open up a position on the market, you will look to trade a certain position size as per your risk amount, what you're comfortable to risk on a per trade basis. So in order to do so, you would look to size your position accordingly. Now when you're trading Forex, the volume is measured in lots. So one lot would equal to 100,000 of the base currency in which you are trading. So one lot is equal to 100,000 of the base currency. That's what we call a standard lot. If you are looking to trade smaller than a lot, say for instance if you're looking to trade 0.10 lots, then you would in fact be trading 10,000 of the base currency. And I'll give you an example now on a currency pair. 10,000 of the base currency is what we call a mini lot, And then if you're looking to trade smaller than that, say for instance 0.01 lots, then you would be looking to trade 1,000 of the base currency pair, and 1,000 of the base currency pair is what we call a micro lot. Of course, you can customize your lot sizes as per whatever amount that you're looking to risk. If you wanted to trade 1.5 lots, or in other words 150,000, or if you only wanted to trade 2 micro lots, or in other words 0.02 lots, then you could do so as well. So let me give you an example. Let's say you wanted to trade one lot of the USD ZAR currency pair. Now remember, as we said, one lot is equal to 100,000 of the base currency. So let me jot this down over here for you. One lot of the USD ZAR. Remember, the base currency in this instance is the American dollar. So one lot is going to equal 100,000. So if we have a quote price of 13.0325 and we are looking to buy one lot, or in other words $100,000 worth of a position, then we would take $100,000 and times it by the quote price, and that would equal to 1.3 million and 3,250 rand. Let me give you another example. Let's say you wanted to trade the Euro USD currency pair. Remember, one lot is equal to 100,000 of the base currency. So in the currency pair, the Euro USD, one lot would be equal to 100,000 euros, as the euro is the primary currency in this currency pair. So 100,000 euros would be one lot of the Euro USD, and if the quote price were 1.4232, then the total would be 100,000 times by 1.4232, or in other words $142,320. Let me tell you a little bit about the pricing of a foreign currency or CFD quote. Now, whenever you pull up your dealing ticket, you will see two prices. One will be the bid price and the other will be the ask price. So the bid price is the price at which you're looking to sell that base currency, and the ask price would be the price that you're looking to enter in at if you were looking to buy. Okay, so the difference between the bid and the ask is what we call the spread, and the spread is the difference shown by the pricing provider in order to for there to be a market. Here's an example on a dealing ticket of the Euro USD, and if we wanted to portion our trade size accordingly to the risk that we are looking to place on a specific trade, as per our stop loss, then we would position size based on the lots that we're looking to trade. So for instance, if we wanted to trade 1.5 lot, we would write it like that. If we're looking to trade 0.10 lots, then we write it like so. Or if we wanted to trade 2 micro lots, then we would, or in other words 2,000 of the base currency, then we could write it like so, 0.02. So that's where you'll fill in the volume, the amount that you're looking to trade on a certain position that you're looking to enter in, and then over here you'll see your bid as well as your ask price. This is the price that you would enter in if you're looking to sell, and this is the price that you would enter in if you're looking to buy. Some more trading terminology for you to be aware of. When we're talking about margin, we're talking about the smaller deposit amount that enables you to open up a position of a much greater value. And then leverage, when we're talking about your leverage, we're quite simply talking about the amount of times greater than your margin that you are able to open up a position as to your margin amount. Or in other words, how many times your deposit or your margin amount is exposing you to an asset of a greater value, be it 100 times, 400 times, etc. Position, when we speak of a position, we're speaking of a trade that you've placed in the market. And if we're talking about opening or entering a position, what we're referring to is the first action you made in order to perhaps buy or to sell to get into a trade. Then when we talk about closing or exiting a trade or a position, we're referring to your second action in order to get out of that trade. Volume, we're talking about the size of your trade, the size of the position that you've opened up. And then ranging, when we speak about a market that's ranging, we quite simply mean that the market is moving sideways. It's neither making higher highs and higher lows, and neither is it making lower highs and lower lows, but rather it's making equal highs and equal lows, and it's neither trending up nor trending down, but rather it's ranging. And then bullish, when we say the market is bullish, what we mean is that we have a bias that the market is mostly comprised of the bulls, or in other words, the buyers, who in most likelihood would push prices continually higher. And then when we speak about the market being bearish, we are quite simply talking saying that we have a bias that the market is mostly made up of sellers and will likely continue moving down. Remember, in terms of the bulls and the bears, the easy way to remember it, the bulls will back you up, and when we say the market is mostly comprised of the bulls, we anticipate the prices will continue moving up. And then a bear will knock you down with its paw. So when we speak about the market being comprised mostly of the bears or the sellers, we have an anticipation that the market will continue moving down. Some important trading principles for you to be aware of in terms of order types. Firstly, let's discuss the two main types of orders. You get market and pending orders. So firstly, when we talk about a market order, we're talking about an order that's been placed at the market price. So the market price would be your actual order price. And then you get a second type of order, which we call a pending order. Now with a pending order, you can specify your order price, and with a pending order, your order price is going to be different from the current market price. With regards to pending orders, you get four types of pending orders. To understand the four different types of pending orders, imagine that this over here is the market price. Now, if you were to buy below the market price, you would use what we call a buy limit. So that's buying below the market price, you're going to use a buy limit. However, if you wanted to sell above the market price, you would use what we call a sell limit. So as you can see, when you are looking either to buy below the market or sell above the market, you are using a limit order. And a limit order is used if you would like to get a price that is more favorable than the current market price. However, you can also use another type of order, and these are what we call stop orders, to enter into the market. If you wanted to enter in above the market price and you were looking to go long, or you're looking to buy, you could use a buy stop order. And then if you wanted to enter in below the market price and you were looking to sell, go short in the market, and you were looking to enter in below the market price and sell below the market price, then you would use what we call a sell stop. An easy way to remember this is if you are looking to buy below the market or sell above the market, then being the more favorable price, because we're South African, we might use the term lacquer. So to buy lacquer, or to buy with a limit, to sell lacquer or to sell with a limit, will get you in at a more favorable price. If you want to get in at a less favorable price, in other words, if you were wanting to buy above the market price, you would use a buy stop, and if you were looking to sell at a less favorable price, you would use a sell stop. The reason why you might use a buy limit is because you want to enter in, of course, at that favorable price, and a sell limit because you want to enter in at that more favorable price. However, I'm often asked, why use a buy stop? Well, if you are using a buy stop, yes, you are entering in at a less favorable price, but you're also entering in with the momentum of the market. So as price rises, you enter with that buy stop, or likewise, as the prices drop, you enter in with your sell stop. So you will be trading with the momentum if you are using a stop, or and on the alternative, if you are using a limit, you will not necessarily be trading with the momentum of the market in order to enter, even though you are obtaining a more favorable price. To visualize these pending order types, let's look at the two types of buy pending orders you get. You've got your buy limit here on the left hand side, and you've got your buy stop here on the right hand side. So let's firstly go through the buy limit. Imagine prices were moving upward as per this line graph over here, and market price were over here, and you wanted to enter in below the market price. This would be your entry price, in which case you would use what we call a buy limit to enter in here below the market. However, if this being the market price moving upwards, the market price being at this particular point over here, at this level, and you wanted to enter in with the momentum of the market as prices increased, in other words above the market is where you are looking to enter in, then you would use what we call a buy stop. And in terms of the sell orders, the two types of sell pending orders that you get, on the left hand side you've got your sell limit, and then here on the right hand side you've got your sell stop. So imagine this were your price of your financial instrument that you were looking to trade, with this over here being the market price, and you wanted to enter in at a price that were higher than the market, in other words a more favorable price. Then if this be your entry price, you would be using a sell limit in this instance. And then for a sell stop, as the prices decline over here, let's say you wanted to enter in with the market's momentum, and with this being the market price, you did not want to enter in at that market price, but you wanted to enter in as prices decreased, then you would use a sell stop to enter in below the market price. To give you an example, on the MetaTrader 4 trading platform of the order types, if you were looking to enter in at the market price, you would use what we call instant execution. However, if you wanted to use one of those pending orders that we've just discussed, the four types of pending orders, you would use pending order and then select your type of order of the four that we've discussed, be it a buy limit, a buy stop, sell limit, or the sell stop. So say for instance, if we wanted to enter in below the market price, we would then use a buy limit. Place our entry price. Let's say we wanted to enter in at 1.3000. That would be below the market price, and then we'd be using a buy limit. You can then put your expiry date in. That's how long you want the order to pend in the market. The stop loss level, where you want to take your loss if the financial instrument moved unfavorably against you, and then your take profit, where you are looking to target in terms of taking your profits. Click place, and that order would be taken up as a pending order to enter in at your specified price if that price got realized in the market, and it would pend in the market for the time period, however many days or hours, minutes that you've specified in the expiry stamp of the dealing ticket. Let's progress and talk about the different types of orders that you can use to either protect your capital or take your profit. So you've got here on the left hand side, you've got your stop loss, and then also furthermore here in the middle, you've got your trailing stops. Now these two types of orders, your stop loss and your trailing stops, would protect your capital. The stop loss will take your loss at a predetermined level. So to give you an example of a stop loss, let's say you had entered in at 100 at the entry point, the entry price of 100, and you had gone long, let's say, so you had, in other words, bought at 100, and you were looking to take a loss of no more than 10 pips as a distance away from your entry price of 100. So in other words, you would place a stop loss at 100 minus 10 pips, in other words at the level of 90. So that would be a stop loss. That's a static order that gets triggered to take your loss at that predetermined level. And then you have what we call a trailing stop. Now, a trailing stop will also protect your capital, but what a trailing stop will do is it will keep increasing as the position that you have entered in moves in your favor. So let's say, for instance, if you wanted to have a trailing stop followed by 5 points, then for every point or every pip that the market moves in your favor, the trailing stop will move your stop closer to the market price by the amount that you've specified for it to follow. And then thirdly, we have what we call the take profit orders, and a take profit will take your profit at that predetermined target price. Here is an example of a stop loss and take profit order where with an entry price over here in a long position, you might place your stop loss over here below the market and your take profit order up here, anticipating that from here where you entered, the market might rally up through to here and hit your target price, your take profit, and that's the level that you would exit if the market rallied in your favor. Alternatively, if from here where you entered the market did not rally in your favor and it declined, then you would take the maximum loss specified over here at your stop loss level. All of these order types can be specified within your MetaTrader 4 trading platform. I'll give an example over here. This is the USD CHF chart. In other words, the Swiss franc paired up against the American dollar. As you can see, the Swiss franc has weakened quite substantially to the American dollar, and this currency pair USD CHF has been rallying quite substantially, moving in an overall upwards position for quite a period of time now. So if you had a bias that the market would continue to be bullish, in other words, continue to move upward and be comprised of mostly buyers who would drive prices higher, then with the market price being over here at this specific level, you might decide you don't want to enter in at this current price, but you would rather prefer to enter in on a pullback to a slightly lower price. Then you would use what we call a buy limit. I'll show you over here. Let's pull up a dealing ticket. Remember, this is a pending order type, so you would specify pending order, and if you're looking to buy below this below the market price being over here, and you were looking to enter in at 1.01785, then you would, of these four order types, choose the buy limit. Specify your entry price 1.01785 and your take your stop loss 1.01290, and your take profit where you're looking to target should price rally favorably and this position move into a profit. So that would be the level that you're looking to take your profit, and then you would specify how long you want that order to pen in the market for, however many hours or days, and then if you're happy with your order and the volume that you're looking to trade, then you can click place and that order will be placed in the market to open up at your specified price. So in other words, you would only enter when and if your price of 1.01785 were realized, with the current market price being 1.02376. If the market price declined to your entry level, then that market order would be taken up. And now you can see in your trading terminal window the order that you've placed in the market, this buy limit order on the USD CHF currency pair at the entry price which you've specified, together with the stop loss and take profit that you've specified, contingent to the order should it be taken up with the current market price. And remember that this is not an order that is now currently in the market, but only a pending order that should the price fall down to your level specified, your entry level, only then will it be taken up into the market. And you can modify your order as well after placing it, whether it be a pending order or a market order. You can right click on the order after selecting it, click modify, and then decide on which variables you want to have changed, be it your entry price or your stop loss level or your profit level. So for instance, let's say you wanted to change your take profit level to 1.03900. You can write it in there and then click modify, and then as you can see, the take profit level got moved, and you'll also see it over here in your trading terminal. You can also change the order visually on the charts by simply dragging the lines to where you would have the order modified. This you can do with the take profit entry as well as your stop loss levels. So also, let's say for instance, if this position were moving in your favor, you had entered in and you were looking to lock in some profit, you could do so with a stop, with your stop loss even, and perhaps moved your stop loss to a static level below the current market price in order to lock in profit. The other way that you could use a different type of stop loss to either lock in your profit or to protect your losses would be to use a trailing stop, which we've discussed. So you can right click on the order, click on trailing stop, and then specify at what level you would like the trailing stop to follow your position should the position move in your favor by, let's say, 30 pips. Let's go 31 pips. You would write it in like that. 3310. That's 31 pips. Remember, the last decimal is a point of or a fraction of a pip. If you wanted to go 31.5 pips, you could write it in like that. And now, as the position moved in your favor by 31.5 pips, your trailing stop would then kick in by moving your static stop loss as the position moved in your favor by 31.5 pips, and by each pip further the market moves in your favor, it will follow by 31 pips. Should the market dip down to 20 pips, it won't move your stop loss. Should it move all the way down to 31.5 pips from its current market price, you'll get stopped out and either take your loss or your profit at that level. So you can in fact actually use stops to take your profits or to lock in profits or to minimize your risk, and then your take profits are to use you can use of course to take your profits in the market. I'll just share with you some common shortcuts and tips very quickly. In order to bring up the crosshair and the ruler, you can click the middle scroll wheel on your mouse, or alternatively click push Control F on your keyboard, and then if you hold that crosshair and drag it, you will also bring up a ruler. I'll show you on the chart now how that works. Another shortcut is using F9 to bring up a new order. That's a quick shortcut if you want to place an order very quickly. And then in order to set the chart constraints, you can right click and then click on the fixed scale, and that will set the chart constraints. And then if you're wanting more charting room, you can push Control M, Control N, and Control T, and that will either close or open your Market Watch navigator or trading terminal windows. And I would suggest you close those windows, all of those, your Market Watch, your navigator, and your trading terminal window, and just leave open your charting window maximized. Then you'll have more charting room to analyze the markets. So I'll just share with you those shortcuts which we've mentioned on the trading platform over here. If you wanted to use the ruler, for instance, or the crosshair, you could enable it by clicking the middle scroll wheel on your mouse or Control F on your keyboard. Alternatively, if you do forget those shortcuts, you can click on this icon over here. If you wanted to take off the crosshair and have your cursor again, you can click on the cursor. So yeah, with the crosshair on, you can click and drag, and that will give you the ruler tool. So if we wanted to measure our entry to our stop distance, we can click on that ruler tool and then drag it, and then as you can see, that second figure over there, 47.2, would be our stop distance. Our take profit from here, our entry level, to should I say, how many pips from our entry level to our take profit would be 201.3 pips. That's the second figure in your ruler. The first figure measures the amount of candles from your entry over here to the left or to the right, and then the third figure is the price at that specific level. So that second figure is the difference in price. The third figure is the price at that specific level, and then that second figure is the difference in price from your entry to let's say your take profit. If you wanted to open up a dealing ticket very quickly, place a new order, you can click up here on the top, or alternatively the shortcut is F9. That's F9 on your keyboard. And then if you want to set the constraints of the chart, as you can see, we can scroll this chart vertically up or down, which is usually not possible. You could normally only scroll a chart from left to right. However, if you right click and then click properties and then click common, click scale fix, in this case it is on though, and set your variables maximum and minimum, or you can just leave it on the presets. Once you've clicked scale fix, then that will enable you to scroll vertically up or down on the chart, as well as compress or decompress the prices to fit the chart into your screen. And then if you wanted to have extra charting space in your charting window, so you could analyze the markets better, and let's say you had open your market watch window and your market navigator window as well, and your trading terminal window at the bottom, I would suggest you close all these other windows so that you can have more charting space. Remember, the shortcuts to open close your market watch window would be Control M, and to open close your navigator window would be Control N, and to close your terminal window, this window here at the bottom, your trading terminal window, would be Control T. And as you can see, you get a lot more charting room if you close those windows. You can even go so far as to open up your chart in full screen, which you can do by clicking F11, which will give you full screen chart. Lastly, let me show you the 4 main trading styles that you may adopt as your own in order to suit your objectives for trading, be it for capital growth, income supplementation, or even as your main income. So if you are looking to trade for capital growth purposes, a very common style to adopt would be that of a position trader, or what we call position trading. Now, if you're a position trader, your holding time is going to be a fairly longer period of time. You're perhaps going to be less hands-on on your trades, maybe making a few trades during the course of a month, and your order time frame is going to be on perhaps the weekly charts. So you're going to be using weekly candles, maybe the daily candles, to enter into your trades, and your trades, you're going to look to hold them for on average about 1 to 3 weeks, and you'll be analyzing the market using the weekly, daily, and perhaps the 4-hour time frames to time your positions when you're entering. Then another very common style of trading is what we call swing trading. Swing trading meaning you would hold it for 1, 2, 3 days, or maybe up to about 5 days. Also, the main purpose for swing trading would be for capital growth, very commonly used by traders to appreciate their capital, taking fewer positions, similarly to position trading, where your holding time is somewhat slightly longer. You're taking less positions during the course of a month, and you're taking a more passive approach to your trading, where you're making fewer trades. Perhaps your position sizes are much larger, and you're looking to trade for capital growth purposes. Now your entry time frame would normally be on the daily charts. A very common time frame to use should you be adopting the swing trading style, and your time frames to analyze the markets would be that of the daily, 4-hour, and hourly candlestick charts. Then if you are an intraday trader and you're looking to trade for income supplementation or perhaps a capital growth purposes, it might be used for both purposes. You might adopt the style of an intraday trader. As an intraday trader, and these two trading styles below, you would be more hands-on on your trades, whereas the swing trader and the position trader, you could be more hands-off of your trades. In other words, you could take a more passive approach and not have to actively manage your trades as much as an intraday or higher frequency trader would. Now, an intraday trader, you might be looking to trade for income supplementation purposes. Your average holding time for trades, as you can see, is a lot less. So you would have to actively manage those trades if you wanted to trade for income supplementation purposes. Normally, an income trader or an intraday trader would be looking to make multiple trades throughout the day or throughout the course of the week for that matter. Smaller position sizes and looking to hold for on average about 5 to 8 hours per trade. Popular time frames to analyze the markets would be the 4-hour, hourly, and 15 minutes, and then your order time frame, the time frame that you normally be placing your trades from, would be on the hourly charts. And then if you're a higher frequency trader looking to trade for your main income purposes, where your average holding time might be an hour to a few hours, you would be using perhaps the hour, 15-minute, and 5-minute charts to analyze the markets, and you might be looking to enter in based on the 15-minute chart. It might be a good idea if you are a new trader to start on the higher time frames, as you will find that there's less noise in the higher time frames as opposed to the lower time frames, where your trading frequency and the susceptibility to what we call market noise is greater. Thank you for watching this third video in our Getting Started series. Hopefully by now you've had a chance to attend the presentation, Introduction to Trading, in the Getting Started series, and also had a chance to watch the videos thereafter in the beginner training series. This is the third video in our beginner training series, and hopefully by now you've had a chance to watch all 3 of the videos and also had a chance to open up your live trading account, get that funded, in which case you would be ready to progress with our training in the intermediate training section. So thank you for attending, and if you have funded your live trading account, then you will be welcome to attend our next training session entitled Technical Analysis 101.